A tip of the cap to you, and thank you for joining us here on the Pilot Money Guys. On this episode or flight, we're going to talk a little aviation news, then go into a little softer topic about being a father, then pop over to a little Q&A, which we're now calling Questions from the Flight Deck, which is our filet mignon of our conversation, which covers an obsession with recessions, strike preparedness, and the market's memory. I'm your host, wealth manager, and 737 Captain Robert Eklund, call sign Rubber Mallet or Captain Rubber Mallet, whichever, either one. Per usual, I'm joined by certified financial planner, former F-16 fighter pilot and 737 pilot Charlie Mattingly, call sign The Godfather. Welcome, Godfather.
Thank you, Captain Rubber Mallet. Good to be back again. We're excited about this one.
Yeah, this is a good one. We got a lot to cover, a plethora, if you will. If I only knew how much that was, it would be set. We're going to jump into aviation news. Delta has their TA out for review. It looks like it's going to be voted on fairly shortly here. And it apparently has strong scheduling changes as well as an hourly pay amount. And that we've talked about previously, but that is a 34% cumulative pay increase in the 4-year contract. Delta's contract offer also includes a lump sum one-time payment, reduced health insurance premiums, and improvements in holiday pay, vacation, company contributions to the 401k and work rules. That's news from Delta there. Hawaiian also has a TA out. An Airbus captain there, I didn't have as much on them, but a 321 captain, Airbus 321 captain would earn $329 an hour in 2023 at the highest rate. And in 2027, it would be $381 for a 38.2% increase. So the increase percentage-wise is more than Delta's. This is a little old news, but I thought it was worth sharing, Charlie, and it's from FedEx. So we're going to talk just a quick nugget here about FedEx. And they actually placed a full-page ad in Tuesdays, and this says Tuesdays, and obviously this is a while ago, but a while back in the Wall Street Journal saying FedEx, quote, FedEx has squandered time and opportunity to bring forth a satisfactory, comprehensive proposal to its pilots. Meanwhile, other airline pilot groups have reached agreements with their pilots, bringing badly needed post-pandemic stability. Pretty interesting there.
Gutsy. So that's from FedEx's union. I can't remember if they're ALPA.
Yeah.
Can't remember.
They are ALPA, because it goes on to say, this is from Captain Chris Norman, a chair of ALPA's FedEx pilot group. He says FedEx was profitable before the pandemic, became historically profitable during the pandemic, and remains solidly profitable today. Now is the time for FedEx to significantly invest in the future of our company with an industry-leading pilot contract that recognizes the vast contributions and sacrifices we made to the industry and the success of this corporation. We must be able to attract the best pilots needed to continue operating reliably in this challenging environment to deliver the world on time.
Nice.
That's pretty interesting. And this is in contrast to UPS, who reached a 2-year extension with their folks there, and the pilots agreed to with their company to that extension. And the airline's president, I guess UPS Airlines president Jim Joseph, issued a statement saying that the pilots play an important role at UPS, particularly over the past few years during the global pandemic. This contract will continue to reward our crew members for their contributions to the success of the company while ensuring we are positioned to provide outstanding service to our express customers. So, and I think they're at $351 per hour for the top cap pay now, and in September 2025, they'll be at $401.
Wow.
Unfortunately, their first year pay is at $52 an hour, but second year is $199, so not too bad.
That's right. That's it's always been that way especially UPS. It seems like where the first year you better just take out some school loans or something.
Emergency fund, baby.
Yeah, emergency fund. We'll talk about that in a minute.
Yes.
Hey, but yes. I'm gonna throw down with some other airline news that you can't comment on, and that is the latest yesterday. The Southwest Airlines pilots announced a strike vote, the authorization to vote whether to have a strike or not. I think I'm saying that right. So that's a step, and that's an aggressive step. And I know that all the pilots probably agree that it's an unfortunate step they have to take, but it's part of it. Delta did the same thing, I believe. I don't know where United is on theirs right now, but they're probably pretty in a pretty difficult stage of their negotiation process as well. These things are just nasty, Rob. That's all there is to it. And we talked about that. And from an outsider's perspective now, from me looking in, it's just like both sides. It's like a boxing match. You just have to go 12 rounds and you both have to fight. That's all there is to it. I guess, I'm not an expert on it, but.
Yeah. Well, it's interesting because we're actually going to have some experts on, I think, next week.
Yes.
Dun, dun, dun.
Dun, dun, dun.
Yeah, a little.
But it's a little confusing because you and I recorded a few of these in a row. So next week is going to be. Wait, no. Yeah.
Actually, yeah, you're right.
Next week's going to be a Hollywood.
It's going to be. Yeah.
We're going to Hollywood next week. Yes.
Thank you
for our 50th.
Point of clarity. Thank you.
Yeah.
Chairman Godfather.
Yeah.
Yes. Next week we got Dave Gesh coming on, and it's just a fascinating interview.
It's going to be awesome.
That was a great one. And following that, we'll have the experts air crew news folks on, hopefully. I guess I shouldn't say it until we have it on the books, but we've got it scheduled, which is great. Fantastic.
That'll be fun.
Okay. Quick tidbit here. Planning for your financial future starts today. Actually, it started before today, but today is all we can control until a time machine is invented. But even then, it will likely only be used for Arnold Schwarzenegger. So Jan and I have a parenting style here, Charlie. We do not negotiate with terrorists. And occasionally our son bears the brunt of our negotiating style. However, I have recently decided to apply that philosophy to my own mind and body and have stopped negotiating with myself even. If my mind says, it's better to get a workout, I get a workout. If it says you'll benefit from a cold shower, I take a cold shower. If it says you need to get your estate planning in order, I get my estate planning in order. I will not negotiate even with myself, which I used to do. Okay. And I admit I'm still working on this, a work in progress. What will you not negotiate with yourself on? Perhaps planning for your financial future? If so, give me a call, 719-624-7055, or give Charlie a call, 865-240-2292. Make sure to call him the Godfather. All right.
Right.
Enough of that. Charlie, what do you think? You want to go? Well, we're going to get into a softer topic now.
Yes.
We're going to bring it down a notch.
That's right. Get ready for get the tissues, Kleenex ready.
I've got them ready for myself.
If you're traveling right now, just get ready for some tears.
And you guys all know I cry already, so that's all
right.
Okay,
I'm ready to jump in if you.
If I start going downhill. This is an excerpt from one of our favorite authors, Vitaly Katzenelson, and he's talking about being a father. So here we go. As I get older, I find that I value material things a lot less. I am still partial to gadgets, but soft things like conversation, walks, experiences have just started to matter to me a lot more than things. My writing was supposed to be about investing, how to make $2 out of $1, but existential topics have lately had a greater appeal for me than discussions about stocks or the economy. Writing the scribble that I'm about to share with you was very difficult because I was writing it. As I was writing it, I kept asking myself, am I a good father? And I was not sure of the answer. So here it is, being a father. Dana Carvey on when you most feel loved in your life. And this is a quote from Dana Carvey. When humans started to call me dad, that is the word that gets me. You are famous to 1 billion people, but only 3 people call you dad. I have a client, and this is Vitaly again. I have a client, her husband was a second-generation American, a Yale-educated lawyer who worked in the family business that was started by his father, a Russian immigrant. 4 years ago, he was diagnosed with cancer. He put up a great fight, but cancer won. And a year later, he was gone at 66. He left $100 million, which went to his wife, son, and daughter. The kids are in their late 20s. I had a meeting with the family recently. The son's wife was a few days away from giving birth to a baby girl. As the son and I were talking about his upcoming fatherhood, I asked him what kind of father he wants to be. He said, I don't want to be like my father. I was a bit surprised and asked why. He said, after my father passed away, his friends would tell me how he was a larger-than-life, gregarious man. I never saw that. My father worked 16-hour days, 7 days a week. He worked in the basement. He'd come up for dinner and go back down. He never spent time with me or my sister. My mom did everything from driving us to school to taking me to football practice. I always felt like I was raised by my mother. I don't want to be like that. I want to be there for my kids. And he went on. My father thought till the last moment that he'd beat the cancer, and so he never expressed his true feelings to me or my sister. A year later, my father's friend told me that my father confided in him that he wished he'd spent more time with us kids. Listening to him, I felt a sudden urge to run home and hug my children. I'm getting verklempt here, Charlie. I also felt enormous sadness. I was thinking, what if he had worked 8 or maybe even 10 hours a day instead of 16, and had left his kids a $10 million pile rather than a $100 million pile? Would it really have made a difference for his kids' lives? They are wonderful, thoughtful young adults who don't have pretentious lifestyles. They live in $200,000 houses and drive modest cars. His son would probably trade all his money for a father who was there for him. I was deeply impacted by the story because as a father who runs a business, I was asking myself, am I doing the same thing to my kids? I shared my worry with a good friend. He has a struggling website design business that has not moved out of the startup phase 10 years on. He is anything but wealthy, but his bills are paid and his family doesn't go hungry. He works 8 hours a day and spends all of his free time with his 3 young kids. As I was mentally comparing these two dads, my definition of what success means got completely redefined. It's not how much money you're going to leave your children, it's the memories you'll leave them with. Our appreciation of material things has a very short shelf life. We value the experiences and memories they create exponentially more. His kids may not have the fancy toys and big houses that some of their friends do, but to them, those things won't matter much. They'll have the warm glow of love their father gave them. As an entrepreneur, you always want to grow your business larger. Your current revenue and profit are never enough. They just set the bar higher for next year. We always want more, but this more has a cost we don't see at the time with our family. It's my core responsibility to provide for my family, but at the same point, I, and maybe some of my readers may say that more is not worth it. P.S. An additional thought, sometimes for us is a game. Sometimes work for us is a game, a real life version of Candy Crush where money is not a currency that buys us material stuff, but chips that we never intend to spend, but are just there to keep count of our success. They are the currency that moves us to the next level and the next level. Just as we mindlessly spend tens of hours playing Candy Crush, our work can turn from being something we do to live into an addiction. As I'm writing this, I keep thinking that on one hand, I was incredibly fortunate to discover my love for investing when I was in my early 20s, but also that there's a danger in this love, which at times can conflict with my love for my family. Yeah, my own father often quoted The Little Prince, and I'm not going to say the name because I'm terrible at French, but by Antoine something Exupéry, you become responsible forever for what you have tamed. So that was it. That was good. Sorry that took so long there.
Yeah, that was good. That is a long one. We decided to do that just because how do you summarize that? And it's interesting. This guy, Vitaly Katzenelson, is somebody that we like to read for investing. You know, he's out in the Denver area and considers himself a value investor, and just really enjoy his writing. We'll put a link to this in the show notes. But he also, and Rob, I don't know if you've read any of his work on, he's Russian. I think he's first generation, possibly.
Ukraine stuff?
Yeah. So he's written a lot about the Russian Ukraine and that perspective. And that's been fascinating to read, you know, as he talks about it, and because of his history, his background. But boy, this article struck a chord in both you and I. And I think one of the things that struck a chord with me was the very last part. You know, his PS, the additional thought. You know, work is a game, real life version of Candy Crush. Now, I've never played Candy Crush, but I do kind of relate to. Well, I guess I can't relate to, like, you know, these tens of millions and hundreds of millions that he's talking about. So I don't, you know, I get it, but I'm like, I don't have to worry about that. But then he starts talking about, you know, is your work like this game to you? And do you just kind of think of it, and maybe there's an achievement game there or whatever? And that's probably what struck a chord with me more than the other stuff, because I'm like, oh, wait a second. You know, I need to be careful that, you know, when we go out, Rob, I mean, my 7-year-old daughter, Ellison, is much more apt to be buddies with my wife, not necessarily just buddies, but closer. They spend more time together. And so now I've got to, like, I've really got to work to get back in there, and hopefully she'll want to spend some time with me too. So it's just it takes a little bit of investment, though, right?
Yeah, for sure. Yeah, no, I definitely saw some, for a lot of the pilots where you try to, beat the previous month or the next month or whatever, or the previous year. I think that can get very dangerous and cost time with family, which is obviously what resonated with you and me.
Yeah. And the airline gig it's such a good thing to be able to go, hey, I need to pay for this extra thing. I've got a kid going into school and I need to make some extra money. And that's awesome that airline pilots have that option, but it's also a slippery slope, isn't it? I mean, it's like, man, that money is out there and it's hard to say no, because you start to put a price tag on your time off. Like, I didn't take that premium trip, and so that cost me $3,000.
don't I dare say, don't think of it like that.
I know.
You got, and if you do, you better be thinking of, hey, what is time? How much is my time with my family worth? And undoubtedly, it's worth more than even $401 an hour. I guarantee you, at the top UPS rate. So
absolutely, yeah.
I think it's fascinating, and it's something that to be honest, airline pilots have an opportunity, maybe more so than a lot of people, to spend time, because when you're at work, you're gone, for days at a time. Hopefully you get paid for that time, and nights at a time. So when you are home, you have more time to really spend it with your family. I know we did a calculation, of course, being a financial planner, and I know we're going down a rabbit hole here, but we did calculations. I was going to potentially stay in the military, and what would my time look like versus going to the airlines. And we did the calculation. I was like, actually, actual time at home. This is, actual facts, not what I feel. Would I be more at home, or would I be home more if I stayed in the military? And by far, it was more time at home if I went to the airlines. And that was the calculation, the theory, and having lived it, by far that is true. Having bounced the airline for me was the best thing I could do for my family, because I got more time at home with them. So
I had more focused. I remember I had more focused time with, like, the time with my daughter. She's older now. She's 17, but at the time we would just go spend at least 3 days a week together when I was a new guy on the airlines, and we went to the aquarium. We lived in Charleston. We'd go to parks, hang out in downtown Charleston. We spent some really good quality time. Now, I was gone 4 days of the week, and I was, my problem was I had a commute, which was my own dumb fault, but nonetheless, it does give you that opportunity, like you said.
Yeah, that's fascinating. Well, okay, we got through that. I didn't cry, thank goodness, almost. But okay, let's bring it. We're going to continue on. Let's talk about again, questions from the flight deck. Let's talk about the market, the market's memories. People have memories, markets don't. Charlie,
that's right. All right. So, Rob, I'll ask you a question to start this thing off here. Is the market up
today? It's up over year to date.
I don't know either. I really don't.
Year to date, it's up.
Yeah. And that's so funny. And I love that you say year to date is up, because that's how we think about the market. Like, it's as if the market operates on a 12 calendar year, and then boom, January 1, things are different, and it's going to behave differently, right?
Yeah.
That's the way we always think. And that's great, because we get to start over, a fresh, clean slate. But guess what? I was looking at something the other day, and this is totally cherry picking data just to have a conversation here. But if you look back at the market since, let me pick a date here, October 12th, and let me share my screen, so in case somebody's watching on YouTube, maybe they can kind of see this with us. But if you look back, and this is me cherry picking data, October 12th, 2022, a 60-40 portfolio is up about 11.5%. And the S&P is up almost 10%, 9.98 is the S&P index since that point in time. Now, what does this mean to us, Rob? Because you said, hey, year to date, it's up. And you're right, it is up, I think, as of today, although we took a hit the last couple of days and maybe are right now. But it's almost irrelevant, because we think about these things and calendar dates and months, And we've gone through this twice before. Like, again, I say we're up since October, but if I were to spend the time and kind of show last year's pattern, you would see that in the middle of the summer, we went from being down in, I think it was mid-August to late mid-September. We were up like 10, 15% from the low. So, man, we were feeling good. We thought, oh, we're going to get through this thing. And then it happened again, and we got hammered again, right? It went down even lower in October.
Wow.
So here we are at this moment in time, and we think we're up, but we're not really sure that that matters a whole lot, right? And the whole point of all this is that it doesn't really matter, because like you said, the market does not have a memory. And we can't control that short-term memory. We can't control what happens today, but we can control our long-term plan. And that's kind of what we're talking about here. DFA put out a great article that says, People Have Memories and Markets Don't, by David Booth. David Booth's a pretty smart guy. He's the founder and chairman of Dimensional Fund Advisors. Also has a little small school named after him up in Chicago's
Chicago School of Business.
Booth School of Business. So.
Yeah, just he paid a little bit.
Yeah. So pretty intelligent guy, but the article is fascinating because he talks about taking that fresh start, and then even though it's a new year, let's take a fresh start. But every day is a fresh start, because yesterday we can't control, and quite frankly, to the markets, it doesn't really matter, right? Now, some people might argue, say, there's momentum here and there's trends here, and there are some momentum things, but nonetheless, he goes on to say, you don't need to believe in magic or be able to predict the future to have a good investment experience. Some people might think I'm giving the markets too much credit, but over more than 50 years in finance, I've come to realize I'm just being realistic. Someone described it to me as a science-based hope. And that's just kind of knowing that, the markets are over the long term, they could go down. We don't know, but the probability is that they're going to provide a return that's going to be a little bit better than inflation. And that's what we need to try to go for in the markets.
Yeah. And leave it to the professor to drop some knowledge on us, Kevin Gormley. And thank you to Dave Getch, who sent us that article from DFA. Again, we're going to have Dave Getch on the podcast next week. It's going to be a good one. Okay. So anyways, the professor dropped this knowledge on me. It was from Dan Sullivan, and it was called, in an article called The Epiphanies in 2022. And he's quoted, as you well know, down markets are the price you pay to receive the rewards of the riskier asset classes when markets recover. Mm-hmm. No reasonable investor expects positive returns every year. It's not going to happen. Yeah. Although much of the financial media, but not this publication that he notes, conveys exactly that message. So, and we talked about this a little bit in pre-show prep. You don't want the market to always be going up, because if the market's always going up and you're in that dollar cost averaging accumulation phase, you're buying less shares. But then if the market goes down, hey, now if you're the same amount of money, you're buying more shares. So even though the bonds and stocks went down in that what was fascinating about that graph you showed too, Charlie, was that 60-40 was up even more so obviously than the S&P 500, which was pretty interesting. But it doesn't mean, hey, you need to be all in, and correct me if I'm wrong here, obviously compliance officer, but it doesn't mean that you have to be all in stocks, or maybe more so in bonds. It just means that you're paying more for risk sometimes. Mm-hmm. And when you see that beta or that volatility go down, and certain things, I guess the beta of the S&P 500 is one, but you see that volatility happen, you're paying for that. So you're going to expect a higher return.
Absolutely. Yeah. It's like the axiom in flying, and you don't take extra risk unless it's worth it. And that's exactly the way it works in the world of investing, is that over time, you should get paid for risk. Now, where that gets confusing is as you approach retirement, and we're going off a little bit of a trail here, but it's actually fascinating to me, the mathematics of this all. People that are, let's say, 60, and they say, hey, I've got some catching up to do, so let's take some extra risk. Well, it doesn't quite work that way. Because along with that, like you talked about, the volatility, the risk means probability of loss. And so if I'm doing that very close to retirement, there's a very good chance that I could actually lose and it not pay off. And our software will show that. It will show a probability of success actually decline if you're taking more portfolio risk, the closer you are to retirement, which is a little counterintuitive because we always tend to say higher risk, higher reward, which is true for a longer time period. But the last thing I'll read here from this David Booth article, which I think is awesome. He says, control what you can control. Again, I said the market's up year to date. It's up since October. We experienced that twice last year. And then in fact, Kevin and I made a video called, is this a dead cat bounce? Because after that goes up, you just get hammered. So we don't know. From now on, the rest of the year, the markets could go down. The past performance just means nothing. Markets don't have any memory. So he says, control what you can control so you can set yourself up for success. And then give yourself some grace. Judge yourself by the quality of your decisions and not by their outcomes. There are so many factors outside your control that can impact investment returns. So that's hugely important. And a lot of times we get distracted, and especially in retirement planning, people say, well, what about this event? What about this political thing? What about, my airline, the status of our negotiation? It's worrisome and it's stressful. But a lot of times we have to say, hey, look, let's just control what we can control. And oftentimes, if we see someone in trouble, it's maybe because of things that they could control, like a spending or a savings component. I think we have more control than we think. It's just that we get distracted. Rob, I believe anyway. That's kind of what we've seen.
That is the perfect segue to both of our next topics, which one is strike preparedness, and the next is the obsession with recessions, which you could have put that one ahead, but I'll go ahead with the strike preparedness. Speaking of some of that stress that's out there, obviously many folks in the airline industry, or actually many folks across the country, have been laid off. And in the airline industry, some folks are thinking about a potential strike, or, if there is a recession, potentially, furloughs and that kind of stuff. In any case, you want to be prepared for that stuff. So this prompted many of us. And the question from the flight deck is, how do you prepare for such an event? And it prompted us to think about it. I even sat down with my wife last night and sat down and thought about, okay, what's our strike preparedness fund, which is our emergency fund. Charlie, you and I have been talking about this for years now, emergency fund. And anyways, we sat down and game planned it out. What if a strike occurred? What would that look like? And I'm not a betting man, and I have followed the mantra. I plan for what can happen, not what I think will happen. So I don't think a strike's going to happen, but I don't know. I'm going to plan for what can happen, and can it happen? Absolutely. Stranger things have happened, right? So thankfully, due to COVID, a lot of us have an emergency fund. We've already thought about that. We've already thought about our core budget and what that looks like. So it took us just a couple of minutes to think about, would we be okay? We have our emergency fund. Will that cover us? How long will it cover us for? And within a matter of minutes talking through it, we knew that we had our minimum dignity floor covered and our monthly bills covered if we struck for, say, 6 months. Not that would be the case. You'd probably be out there looking for different jobs, which is why we'd have an additional to the emergency fund, which is why we say either 6 months to a year of an emergency fund there. We also thought about our son's college. It's paid for. The one area we may need to think about a little more is being able to continue to invest when the market, if there is a recession and the market is down and we're out on a strike, we wouldn't be investing in the market. So maybe have some money ready to invest there or invest it earlier, either one of those. But Charlie, what do you think? This begs the question. Obviously, we talked about it before, but we have an emergency fund. Where do we put that money?
Yeah. First, I loved when you told me this story because it's just such a good example. First of all, real life, the things that we all deal with, especially in the airline world. But secondly, that there's this very unlikely event. And a lot of people's inclination may be just to dismiss that and not even think about it. But it is a source of stress, whether we realize it or not. And you just said, hey, we took just a couple minutes and you were intentional about addressing this concern, however unlikely, And that's a huge stress reliever. And, I love that we do that with our clients that we work with, and we recommend anyone get a plan. And a plan is not some static one-time piece of paper that says, this is what you're going to do. It's an iteration, a continuous iteration of these events, whether likely or unlikely. Obviously, retirement is very likely. And we love to go down these paths and explore the possibilities. In fact, we call it possibility planning. And it's a positive thing. Preparing for a strike is a little bit of a difficult thing, but preparing for retirement, we hope, is fun. But just taking some time to do that reduces uncertainty, and uncertainty is what really, really reduces our quality of life. And like Dave Getch said on our podcast that'll come out next, is like, man, when you take some time just to think about those things, it not only increases your success in retirement, which may be years down the road, but it helps you so much right now. Just like you and Jana, you talked for a few minutes about this potential thing that could happen, and now that stress is reduced. It may not completely go away, but I love that, Rob. That's why I'm glad you talked about that.
Yeah, it was fun. It was, I say fun. It wasn't fun, but we game planned it out. Any game, and kind of thinking about it definitely reduced the stress, because we're ready for the potential. If it happened, and that's what a lot, obviously we talk a lot, or I talk a lot about stoicism, and when you think about the worst case, in this case, we actually strike, we're ready for it.
Yeah.
And when that happens, okay, we know what to do. We got the plan ready, like you said. I love it. And to just kind of throw in a couple of the blocking and tackling nuances. When I think about an emergency plan, and throw in here, Charlie, I think about, hey, the first place I look is I bonds. I love I bonds, knowing that it can't be part of my emergency fund for the first year. Mm-hmm. So it can't really be a part of it. So start investing once a year hits. Now it can be part of your emergency fund. Yeah. Then I looked to CDs, and we talked CDs. Obviously, interest rates are coming up. You might take a hit, as you alluded to, Godfather, about you might take a hit if you draw those CDs out early, but you can get to them. You can get to that money. So you invested in a 4-year CD. The interest rate's a little higher. You might be able to get that out without a couple months interest penalty. And then finally you might want some in the bank or a savings account, money market account, something like that.
Yeah. Right away. And you can get 4% on these things now, which is amazing. And it's T-bills right now. And if anybody's done I-bonds like we have, you just go on the same website, treasurydirect.gov. You can buy treasury bills, and you can buy, and a bill is, I think it's is that less than 2 years? I can't remember the exact time frame before it converts to a note, treasury notes. You got treasury bills, treasury notes, treasury bonds, but nonetheless, treasury bills are the shortest terms, and actually happen to be the highest paying terms right now at 6 to 9 months. And you're probably going to get around 4.5%, which a lot of people still kind of don't know that you can get that. It's not been that long that you can get those good rates. So those are great places to stash some emergency funds, some cash if you've got it sitting around. Even banks now are starting to catch up with their CD rates, upwards of 4%. I've seen it, some online banks and things like that. So those are starting to be, I think the days of, unless we go into a recession here in the near term, the days of just letting cash sit there is not necessary anymore, because you've got some opportunities, you've got some options to get 3 to 4.5%, which is great.
That's fantastic. We're not excited enough about that, I don't think. But you and I are, but most people aren't. I just double checked you too. You're exactly right. T-notes or treasury notes are 2 to 10 years. Bonds are 20 to 30 years, and T-bills are 4 weeks to a year. So
yeah. Last year, Rob, and it was markets were down, and we were all, they're still down, right? I mean, we're not passed through it yet, but one of the difficult times, one of our clients said, "Let's put everything in T-bills, man. They're paying 4.5%. That's like 15% better than what we're doing now." And I was like, Yeah, but we're kind of in a long-term situation here when it comes to retirement. So it's
Jason Zweig, I gotta go down this road. He's one of the great. We obviously read him a lot too, with the Wall Street Journal, The Intelligent Investor, and he talked about this, and he's way more eloquent than I will. But he talks about the term realized. and it's a French term. He goes through the whole history of it, but realize comes from something that's real. And not that your money in your 401k is not real, but until you take it out, you don't make that real. So the market's down again. That's good for us, monthly investors, yearly investors. So anyways, I thought that was interesting that his article talks about, hey, what does realized mean? And it's when it becomes real.
Yeah. And even someone on the cusp of retirement, because I know that people that are listening are like, yeah, but I'm getting ready to retire. You still have to have stocks, some, and it's okay that they're down. It's just, you just want to avoid removing them. Like you said, realizing those losses. Do not realize or make real those losses. Even if you're on the cusp of retirement, you don't have to do that. Now, the tough part about last year, I will admit, is that bonds were also down and had the worst year they've ever had, which made that challenging. But that there is a silver lining to that, Rob. These interest rates that they're paying will eventually, allow them to be a good vehicle. In fact, you talk about future rates, expected rates are pretty decent for bonds now. So
yeah.
So hopefully that's some consolation for some people. I don't know.
And that leads us right to a great, our last topic here, obsession with recessions. Charlie.
Yeah, no. So we talked about this on, I can't remember, was it 46 podcast flight 46? But
I think so. Yeah.
Yeah. We talked about recessions and kind of like, well, if we're meeting all the criteria and it just hasn't been announced yet, then so what? I mean, the market's already digested that information, whether there's an announcement or not from the National Bureau of Economic Research. So our good friend at Dimensional, Carson McLean, who takes care of us on these podcasts and gives us great information, they talked about, he gave us an article and said, and I'll just read one blurb here, but it says, according to the National Bureau of Economic Research, there have been 12 recessions since 1947. S&P 500 returns following the start of those recessions have generally been positive and similar to all months, especially for the longer 3 and 5 year time periods. How can that be? Basically, if markets are anticipating a recession, this is what you and I talked about, it's already been embedded in the prices. Markets are forward-looking. Stock prices incorporate not only an evaluation of days past, but also expectations for the future. Plus, recessions are declared with several months delay, so markets have often readjusted to deliver positive returns shortly after the start of a recession. When it comes to recessions, it's not clear your portfolio needs to make any concessions. I think that's just their little clever conclusion there. But it's interesting, what to do if we go into a recession. Well, that's probably already behind us as far as the stock market's concerned.
Yeah. Yeah. David Booth has some great quotes on that. And one of them is he talks about recessions and how the next, or articles, I should say, not quotes. He's got some great quotes too, but the recession, how the market does after recession. And a lot of times it's bouncing back. Mm-hmm. And obviously look at the charts that we've had. I think it was in 46 there where we threw the chart in there. The returns after recession, super important.
Yeah, the last thing I'll say, Rob, as I was reading these articles, about the market memories and this recession thing, is I just wrote down, reminds me of the game shows, or when you play a game of some sort, and they always say, you must be present to win. I think that's the market. You just have to be present. You got to stay in the fight. You can't get out of the markets, especially repeatedly, and try to time and outsmart things. It's just a losing strategy, and that's just, it's, that's the way it is.
Yeah, I love that. Love it. Well, what else you got, Charlie? Anything else you want to?
No, that's it. That was fun. That's all I've got for today. Looking forward to the next couple, though.
Yeah. Okay. So we're in the kind of the fatherhood mindset here for a little bit. So a couple of quotes to leave you with. This one's anonymous, but when a father gives to his son, both laugh. When a son gives to his father, both cry. Almost cried just right there. And this one's by Fanny Fern. To her, the name of the father was another name for love. No. That's it. Let us be the first to welcome you to the final destination of Flight 49, where we covered a plethora of topics, from being a father to strike preparedness to an obsession with recessions. Would it be wrong to say you like this podcast? If not, we greatly appreciate reviews and subscribers. Please shoot us any questions you would like us to cover during the Q&A portion of the show, or what we're now calling questions from the flight deck. And remember, as Emerson said, the world makes way for those who know where they are going. And as I say, so plan accordingly. From all of us at the Pilot Money Guys, we wish you smooth rides and in the zone, soft, but more importantly, safe landings. Bye-bye.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only. It does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from these projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.